welcome to our Income Art channel where we provide valuable tips and tricks on how to invest in the stock market. Today we are going to talk about quantitative analysis which helps to invest in the stocks to get good profits. Stock quantitative fundamental analysis is the process of evaluating companies' financials and economic fundamentals in order to determine its intrinsic value and potential for future growth. This can help investors to make informed decisions about whether or not to buy, hold, or sell a stock. Now, what is quantitative analysis? Quantitative analysis is the process of collecting and evaluating measurable and verifiable data such as revenues, market share, and wages in order to understand the behavior and performance of a business. However, with data technology, quantitative analysis is now considered a better approach to making informed decisions. Although this is a vast subject, we will learn vital knowledge that is required to invest in the best companies. I have included few factors below that can be used to predict how the company or a stock will do in the future. First one is market capitalization. Market capitalization or market cap is a term used to represent the market value of a company based on its current share price and the total number of its outstanding shares. It is one of the most important characteristics of a company and useful for prospective investors in understanding the risk of investing in a stocks of the company. How to calculate market cap? Market capitalization can be calculated by multiplying the number of outstanding shares of a company by the current price of its shares. For example, if I have a company A and it issues 1 lakh shares at a 100 rupees each, its market capitalization will be multiplying the 1 lakh share with 100 rupees. Then its market capital will be 1 crore rupees. And next, company market capitalization can be used to categorize them as large cap, mid cap, or small cap companies. When a company's market capitalization exceeds 10,000 crores, it is referred to as large cap stocks. When it is between 2,000 to 10,000 crores, it is referred to as mid-sized stock. Small cap stocks are those with market capitalization of less than 2,000 crores. We can diversify our portfolio of stocks based on this. The ideal stock portfolio for investors would consist of at least 50% of large cap stocks, followed by 30 to 35% of mid cap stocks, and 15 to 25% of small cap stocks. This helps to protect our portfolio or investments. The next important topic is quarterly earnings per share. The concept of earnings per share is very simple. The reason behind starting any business is to make a good profit. Everything in a company, including sales, employment, operations, and the adoption of new technologies, are finally works for making a healthy profit. The formula for calculating the earnings per share is profit after tax divided by number of shares. Let's talk about earnings per share. In the previous example, we have seen that company A had uh, 1 lakh shares and that each share is worth 100 rupees. Say company A has made profit of 25 lakhs for the current financial year. However, since this is a business, they need to pay taxes. So just take this 25 lakhs profit after paying the corporate or income tax. The EPS is currently calculated by dividing the total profit after tax by the total number of shares. So here EPS is 25 rupees. Suppose if I have 100 shares of this company, I will be getting 2500 as my profit for this year. This is for a yearly EPS, right? Then what is quarterly earnings per share? Every business files its taxes on quarterly basis. So by this, we will be getting to know the quarterly profit of the company. We shall take into account quarterly profit when calculating the quarterly EPS. We need to compare each quarterly EPS with previous quarterly EPS. because business will make money according to the seasons. Quarterly EPS is crucial. Take Asian Paints as an example. During the rainy season, no one will paint their homes. Hence, Asian Paints won't make much money in this season. If, for example, Asian Paint business last quarter's earnings per shares were 15 rupees and this quarter's were 17, it would be a great sign to invest. Why? Because it's increasing. For this reason, we need to compare quarterly earnings per share to the same quarter last year. We must assume that the company is doing well if the profit increases. Next topic is annual EPS. As we previously discussed, it is similar to quarterly EPS, but in this case, we take annual profit after tax when calculating the annual EPS. So we call it as a company's yearly profit. The following considerations highlight the significance of EPS when assessing a company's financial health and profitability. First one is a higher EPS means more profitability, which suggests that the company may increase dividend payout over time. Second one is it helps compare the performance of good companies and also it helps pick the most suitable investment options. And third is EPS not only helps measure a company's current financial standing but also helps track its past performances. EPS can also be used to compare the financial standing of a company over the past years. Companies that have the steady EPS increase can be a reliable investment option. Conversely, companies' irregular EPS are usually not preferred by a good investors. Next important topic is P/E ratio or price to earnings ratio is a quick way to see if a stock is undervalued or overvalued. And so generally speaking, the formula to calculate P/E ratio is the stock price of a company divided by its earnings per share. Let's calculate the P/E ratio using an example. In accordance with the previous example, company A has 1 lakh shares and we have calculated that its EPS is 25. We already know that each share costs 100 rupees. Here the PE ratio is calculated price per share dividing it by the company's EPS. 100 divided by 25 equals to 4. So currently company A's PE ratio is 4. Here what is PE ratio and why we use it? Here are few important things to remember. The Indian market's PE ratio is between 20 to 25 on average, but it hasn't been fixed. Nowadays, it's not necessary to compute each firm's PE ratio. You can find the precise PE ratio of any company simply searching on Google. A low PE ratio suggests that the company is losing money or reporting low earnings. For a high return on investment, we should not invest in a business with negative PE ratio. We should not compare the PE ratio of various types of businesses such as IT and consumer product companies when comparing the PE ratio of various businesses. Companies in the same industry should be compared such as tech firms with other tech companies and construction companies with other construction companies. The lower PE ratio is the better for the company and potential investors. Thanks for watching and don't forget to subscribe for more valuable content on investing in the stock market.